Hi traders, welcome to this edition of Expert Market Analysis brought to you by Arante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, which I'll just bring up here, and hopefully you can see that now. Let me just double check. Okay, yeah, you can see the disclaimer now, that's good. Well, I'll just let you have a look at that. Well, I'll just run through some of the brief objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, however small, however big, please do ask them along the way, and I'll hope to answer them as soon as possible, or at least after the webinar finishes. Okay, for the next 30, 40 minutes or so, we will hope to get through, well, there's quite a lot happening really in markets actually. We'll just check out where markets are currently. We'll look at dollar, yen, and oil in particular, just because those are really sort of key headlines that are stories that are grabbing the headlines really at the moment. We'll check out equities and the US indices and some of the technicals around those before then just reviewing a couple of key data points that we had last week, so non-farm payroll and Eurozone inflation. Before then also looking at the RBA, which met the Royal Reserve Bank of Australia, met yesterday, of course, and then we'll then look at this week's main events, which are today's ISM US data, and also, of course, the Bank of Canada meeting, although not that much is expected from them. But as I say, a lot happening in markets currently, and really interesting to see well, yes, the developments really since the long weekend in the US. Equities are mostly in the red after the muted handover from Wall Street. Really, European stock trade on the back foot on really downbeat German data, with industrial orders falling well short of expectations, despite some factors facing apologies. Potentially had hawkish the chance of a rate data from lower, with sentiment really close to stronger rising oil prices. US futures, they are trading lower after mixed comments from the Fed's Waller and Mester. In the FX space, the US dollar is consolidating yesterday's highs really, again after its bullish move on Tuesday after that long US holiday that we had. If you just bear with me, I just want to pull up the first chart actually, which I'm struggling to locate, which is a problem. Apologies. Here it is, which is dollar yen. Yes, dollar really consolidating around its highs. Apologies, but yes, we've also had various forms of intervention in the FX markets, including physical action in China and India already today, along with a noticeable rise in volume from Japanese officials. Here we got the dollar yen chart, and you can see the rapid rise really, well, since, of course, well, this year, of course, but we've had it over the last part of the last week really, from sort of below 145 to above 175.5. You can see here this push higher just this week, after consolidating around sort of 146 or so. That spurred, as I said, verbal intervention from Japanese authorities overnight. Top currency diplomat Kanda basically stated that if these moves continue, the government will deal with them appropriately without ruling out any options. Following that announcement, well, dollar yen dropped actually to 147.5, but later then hit a 10-month high at 147.80. But you can see we're just back again lower at the moment. Japanese authorities, well, they last intervened in October last year. An estimated 70 billion they spent defending the yen effectively. If I just show you here, you can see that sort of intervention around similar levels. The big dotted line I've put on there is the 145, and then we had this intervention after we sort of spiked up through there and then to that 150-194 high, and you can see that then markets really being wary of that intervention and then turning lower eventually. Interestingly, kind of now a slightly different scenario. It seems kind of tough to fight this US Treasury yields rally that we're currently seeing. And really the main driver for dollar yen potentially will be more fundamental, and it's the exit from the accommodative monetary policy that we see in Japan still. And another thing to bear in mind as well, we think, is that volatility measures generally they're quite muted as well in this FX space. So, and for the major especially, so relatively orderly market conditions sort of go against intervention reasoning. Of course, jawboning will continue potentially, so just be mindful of that. And obviously then this pickup, if we do get sort of certainly towards 150 and possible physical intervention. Okay, that's dollar yen. I also want to just show you, if I can, just bear with me, oil, because that is obviously getting a lot of headlines at the moment. We don't often look at oil too much, but just bear with me. I'm just pulling up the chart here, which is just here. Updating, it is updating. Yeah, this is the weekly Brent crude chart. So yesterday, Saudi Arabia announced that it's extending its 1 million barrels per day unilateral output cut through the rest of the year. This was meant to be temporary, remember. So they're extending that production cut through till the end of the year. This, of course, sent oil prices higher, new year to date highs. Brent briefly trading above $90 a barrel. It's interesting, really. On the one hand, you've got markets and economies now sort of need to deal with the consequences of higher oil prices, and potentially then we've seen core sticky inflation or inflation generally still above target, and we've got a chart to show you actually for that. But yes, stickier inflation will be an issue and mean obviously this theme around higher rates for longer will continue. On the flip side, markets and economies, in particular oil importers, should kind of find comfort in the fact that by keeping its oil production at a very low level, Saudi Arabia has only managed to increase prices so much. That kind of reveals that demand is weak, especially from, say, China and Europe. And it shows as well, actually, that other producers are gaining market share. And for example, the US will likely produce record amounts of crude this year, and there are also new producers coming online. For the dollar then, interesting, it's kind of US energy independence that people are talking about now, and its net exporter status. That kind of leaves the dollar well positioned for higher energy markets. And then on the flip side, opposite to that, it's really not welcome for the already sort of badly hit, if you like, yen and the euro. They're both net importers of energy, and that kind of possibly fears of last summer's negative terms of trade theme, which we had especially in the euro, although certainly LNG prices are more stable than last summer, as I mentioned. So you can just see this chart here, this sort of strong resistance line, this dotted line here, which is at 89.33, which is the high from January. That was the year-to-date high, and we got up to 19.95 this morning. You can see, I think that's this morning, just double checking. That's the weekly chart anyway. So big resistance around 89, pushed above it today. Not sure why this is taking so long to reload, but bear with me 1 second while I get the daily crude chart. So you can see the 89.33 resistance level. I've got a fib level in there, which is around sort of 89. So that's been a key level. It was yesterday, actually, we pushed it up to 19.95, as I mentioned, and then we just pull back now here. So whether we see some resistance around 90 or push above it, you can see the RSI, the daily is now overbought. Doesn't mean we can't go higher, of course, but just warning, potentially we get a sort of pullback or just sort of consolidation around here. But certainly if we consolidate around 89, don't drop below there, then potentially we can push higher in oil, and the repercussions for that we've mentioned on some of the currencies as well. Okay, otherwise, really worth bearing in mind what is happening later this month. I have got a chart in here as we get on to equities shortly, which I'll show you. But there is a lot of focus, of course, as well as sort of the intervention levels in some of the currencies, as well as high oil prices. We do then have a round of policy meetings by numerous central banks. We've had the RBA. We'll look at that shortly. Bank of Canada today, then we have the ECB next week, and then the following week we have the Fed on the Wednesday, Bank of England on the Thursday, and then the Bank of Japan a few hours later on the Friday. So a lot of rate decisions to come, policy meetings, and this is of course after we've had quite a long gap through August, through the summer, and before then the July meeting. So I should point out we do as well get some key inflation reports during this time. We get US CPI next week on the 13th. We then get the following week Eurozone HICP inflation basically, and then UK CPI on the 19th and the 20th of September. So a lot going on, and we just want to highlight then this chart here, which if you just bear with me, I will get. Just 1 second, which is here. Hopefully you can see that now, which you can. Just concerning stocks, of course. So anybody, any sort of seasoned professional who's been looking at markets a long time, like myself, then as the calendar kind of transitions now to September, we kind of don't need any reminders of the so-called September effect on risk appetite. And essentially, this chart shows you everything you need to know about September, the worst monthly returns on the S&P 500 we get in September. That's since 1928, sort of around -1%. 3 other months only show negative returns, May and February, but by far much less than those September negative returns. That's the average month-on-month change, percentage change. So just to bear that in mind, of course, doesn't mean it's going to happen, but just something to note. And just generally, closer to home, of course, US equities, well, yesterday they closed mostly lower. The recent weak global PMI data, and then of course rising yields have weighed or are weighing again on risk taking. Energy and tech outperformed yesterday, so the benchmark S&P that settled 0.42% lower, just below 4,500. Then we had the tech-heavy Nasdaq that actually finished up 0.11%, but the Dow lost 0.56%. That settled at 641. Airbnb, that surged 7.2% due to its impending inclusion in the S&P 500 that begins on September 18. And Tesla also jumped nearly 5%, 4.7%. It was up and closed after reporting strong year-on-year and month-on-month Chinese sales growth in August. Okay, let's just show you first of all a chart. Just bear with me 1 second. You've got that chart there, which I've shown you, of course. Just bear with me while I pull up to look at some of the technicals, which is here, of course. That's oil. Just bear with me 1 second. Just to look at some of the technicals around the S&P 500. This is very annoying that this is taking so long, so apologies for this. But just bear with me. S&P, yeah, so we've got this, let's just pull up the weekly chart. We've still got this ascending channel in place here, bullish channel, you can see highlighted here. And we dipped out of it a few weeks ago, and then we're back into it last week, and we're just sort of hovering around the lower part of that. Nice series of sort of higher highs, higher lows, but whether we still stick in that will be interesting to see. There's a lot of dotted lines on here, but if I just show you, well, we've got a couple of fib levels, actually, a minor fib level at sort of just above 4,500, which potentially will act as first resistance. If I just take that off, then we've got this swing high up here from March at 46.37 as well, which sort of capped the upside previously. So yes, if we can push up, then sort of 4,500 and then 45.41, which is last week's high, may offer initial resistance before then we get up to sort of 4,600 or so. Otherwise, support is probably then this recent mid-August low at 43.35 if we do just sort of hover around current levels. Just pull up the NASDAQ. Again, ascending channel, we've broken out of that, but possibly we're back in or back up towards those levels, towards 16,000. Probably that channel is now broken, so should take that out now, really. We've got short-term fib levels in there, but probably the next, well, possibly now level of support is this March high at 15,265, and then we've got the recent high from July at 15,932. That's the NASDAQ 100. Interesting chart we think is the Dow, because we've highlighted this sort of level of resistance come now possibly support 34,281, this thick dotted line here, capped the upside numerous occasions, strong resistance, then we broke above it, then couldn't quite sustain it with this sort of swing high here from back in April last year, 35,492. That was resistance. Did then dip below the 34,281, but didn't close above it, didn't close below it, sorry. So that sort of reaffirms that importance of that level, and we're just sort of oscillating between those two now. 34,281 support, 35,492 resistance. Okay, that's in the Dow and stocks. Okay, let's now go to last week's, a quick recap of last week's data. Firstly, let me just double check you can see that. Yes, you can. So a review of the non-farm payrolls report, always a very important report, suggested really overall a soft landing and potential Goldilocks scenario, basically where inflation comes under control without causing a recession. So the headline number 187,000 in August versus 170 consensus, but there were net 110,000 of downward revisions to the past couple of months, indicating that the slowing trend in employment growth remains in place. Here's all the main numbers. I think the household survey, which is used to calculate the unemployment rate, reported a slightly stronger job gain of 222,000, but the number of people classifying themselves as unemployed rose over 500,000, which kind of points to more and more people returning to the labour market. That was a big point from this report. And that increase in the participation rate is really what the Fed wants to see. It was at 62.8% and it's really risen quite nicely from a year ago when it stood at 62.1, and that essentially should possibly or potentially help to keep wage pressures in check. So in that regard, yes, wage growth, average hourly earnings is soft pretty much at 0.2%. So that was the smallest increase since February last year, while the unemployment rate jumped to 3.8% from 3.5%, and consensus was 3.5%. So going forward, you kind of got to think with higher borrowing costs, less credit availability, and then also there's lots to mention about student loan repayments. They're all potentially factors set to increasingly weigh on economic activity, which means then the unemployment rate is expected to climb further. And sadly, it is unlikely to be just through rising participation rates, but will likely mean job losses as well. So that's a key factor to look out for going forward. And certainly if that happens, then some economists, of course, continue to believe that US interest rates have peaked. And it's safe to say, of course, that the Fed isn't hiking in September, kind of 90% plus chance of that happening. So unchanged rates in September. And especially with the core CPI set to slow rapidly, potentially in the next couple of months. Then the question is about, of course, the November rate hike. Let's just now look at, bear with me 1 second, I'll just put up I just want to show you actually how rates are differing for the Fed meeting. So we said September meeting, 20th of September, that is. This is the CME Fed Watch Tool, really useful device. Essentially, it shows you there what is the likelihood that the Fed will change their Fed target rate at any upcoming FOMC meeting. This is basically Fed funds futures pricing. And you can see 93% chance that rates stay unchanged at 5.25 to 5.5%. Very small chance that we get a 25 basis point hike. But November now, with these rising yields, just bear with me 1 second. Let me refresh. It's not letting me show you the 1st of November FOMC meeting odds. But while I refresh, just bear with me 1 second. That was around 40% plus now. So that's moved around quite a lot during the summer months. During the summer weeks we've just had, was sort of down below 40% even at the start of this week, sort of 35% now, but has jumped up to around 45%, so near for the November meeting. It's just we'll just leave that for the moment, but just take my word for it, that has increased, and that is obviously helping the dollar with these rising yields and the chances of a November hike. Sorry, not show you that, but we'll just show you for the minute. Basket of currencies against 6 of its major trading partners. The euro by far the biggest weighting in the DXY. Remember, about 56.50. %, or so. So just bear with me 1 second while I get that chart for you. Apologies about this because it's really a little bit annoying, but we'll get to this dollar very soon. Speaking, have made new highs. We broke earlier this now towards levels we haven't seen for many months. Just bear with me. Before we get to that, then let's just go also to, I can show you this actually when we go through the ISM data, the preview. Just bear with me 1 second. So just before we get to that, we'll just review Eurozone inflation data from last week as well. That stalled at 5.3% in August, as rising fuel prices and the removal actually of electricity and gas subsidies in countries like France caused energy inflation to rebound. This certainly will fuel concern about inflation remaining more stubborn than anticipated, of course, and we still have these moves in Brent and crude to account for. That said, the overall trend actually in inflation remains cautiously disinflationary. Otherwise, developments in goods and services inflation were more or less as expected. And then we had core inflation, so that excludes energy and food, declined slightly from 5.5% in July, but certainly at 5.3%, it's only returned to its level at the start of the year and still remains close to that record high we saw in March. As I said, looking ahead, more declines in inflation are in the making. Germany, certainly economists expect a significant drop next month as base effects from government support drop from the data. Surveys also point to a sizable disinflationary effect for goods prices, while services inflation is set to fall more slowly thanks to higher wage costs, and that is an issue, certainly for Europe as it is for the UK. Indeed, wage growth is still trending above a level consistent with 2% inflation. So for the ECB, these August inflation data were among the most important data points, certainly ahead of its meeting next week. Inflation kind of remains stubborn enough for the hawks to remain uncomfortable, but does look like a further deceleration in price pressures is in the making in the next few months. That is, of course, allowing for these elevated, as I said, crude energy, oil prices. We have to remember as well, given the ECB mantra over the recent months that doing too little is worse than doing too much in terms of hikes, then certainly some still expect another 25 basis point rate hike next week, despite that only be given kind of a 1 in 4 chance at the moment by markets. So a 25% chance at the moment of a hike next week. That is a 25 basis point hike next week. I've just got another chart in here I want to show you, which I mentioned earlier, just showing you the difference is in some of the core inflation rates between the regions. US, of course, this is the core PCE, which is well, that strips out changes to volatile items. That's still well, that's now down to 4.2%. That contrasts with say Eurozone, and then of course the UK. And it's interesting if you think potentially the Fed is stopping raising rates, whereas there is probably one more expected by markets, if not next by the ECB, and then 2 such moves for England, really to tame that very high sticky core rate effectively. I think there's around 57 basis point priced in for Bank of England, with peak rate around or just above 5.8%. This week, just for the euro, just bear with me 1 second while I just try and grab the charts for you. That's better. So euro dollar chart, good to look at this. We'll look at the daily. Actually, you can see this descending channel, the opposite really to that DXY chart, if you like. So falling from the high in mid-July, if you remember, 112.75, series of lower lows, lower highs. Basically, we popped out of the channel slightly, sort of end of August, but then firmly back in it, and we basically had a fib level, which was the halfway point of this decline. That was at 109.42. That capped the upside, you can see there, plus the 100-day moving average, which is the grey line at 109.15. And now, a kind of 200-day had sort of capped the downside earlier in August. That's at 108.20 now, but we really smashed through that last week, and then that is now probable resistance as we're now moving lower, and it really looks quite ominous, having lost sort of the recent low at 107.65, which you can see sort of was around near-term support. At least we've crashed through that yesterday, and we're heading possibly towards 107, and then this sort of area of support, which is around 107 and just below, but the descending channel firmly in play still. Okay, that's the euro, euro dollar, and last week's data. At least we should probably review now the RBA meeting we just had on Tuesday that I mentioned. As expected, they kept the policy rate unchanged, 4.1%, and that really leaves the bank further time to assess incoming data. The Australian economy kind of experiencing a period of below trend growth that is expected to continue for a while. Even so, conditions in the labour market, they do remain tight. Monthly CPI in July continued to decline 4.9% year on year, but kind of remains too high, potentially will remain so for some time. The RBA forecast for CPI actually is seen continuing to decline to be back only within the 2 to 3% target range in late 2025. So the bank essentially concluded that some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. It was actually the last meeting chaired by Governor Philip Lowe, with Deputy Governor Michelle Bullock replacing Lowe, and that starts on September 18. Aussie dollar then, this is the chart. It's kind of been or the Aussie certainly looks towards China and that economy, which is struggling, of course. Grim PMI figures, which has hit the Aussie for sure quite badly. One of the worst performing majors last month, certainly. Although the bank or the RBA, as I mentioned, has kept the door open to more tightening if needed. Essentially, though, it's kind of a data-dependent approach like other major central banks. Market's really not pricing in any more hikes by the RBA, but it kind of does mean to us possibly there is room for any dovish surprises, any room for dovish surprises to hit Aussie kind of is small. Certainly the considerable amount of risk premium now is priced in relating to that slowdown in the Chinese economy, you'd think, which then means it can show a sort of asymmetrically positive response to any positive news. That would be our take, really, if we get more prolonged monetary fiscal stimulus from the Chinese authorities, which we have had, then potentially that will help the Aussie rebound. But at the moment, well, you can see we broke down through the sort of long hand. As we said, the bar to positive surprises is pretty low, so potentially we could push up with sort of near-term resistance, probably around 65.22, and just yes, 65.21. Okay, that's the Aussie dollar. Otherwise, this week, yes, we do have US ISM services PMI data that is out today. Expectations for little change. Consensus expected 52.6 and 52 flat, with the ease to a 6-month inflationary pressures seem to have weighed on the near stall in the third quarter. Service sector-led acceleration of growth in Q2 has now faded, and a resultant fall in new orders received by firms in August could tip output into contraction in September. So watch out for this. Has been a market mover at the start of the year when we dipped below 50. That obviously that 50 number denotes sort of boom bust territory. Expectations 52.6, remember, so not below 50, but yes, interesting whether we do push down near to that. Certainly though, for the dollar, you kind of think that it will consolidate those recent gains. Let's just pull up the DXY chart, which we can see now. Apologies for that, we couldn't show you that earlier, but you can see, well, the weekly chart getting into sort of, yeah, we've sort of pushed above these recent highs from May, 104.69, and now we're getting up towards the highs from March around 105 and above. So interesting whether we can push above there. That's blue lines of 50-week moving average, 104.36. But if we do rebound, then potentially, yeah, sort of 105.88 is the target for dollar bulls. Okay, otherwise, one last look at the Bank of, oh, bear with me one second. Apologies, bear with me one second. Here we've got the yeah, the dollar chart. Sorry, I didn't mean to show you that. Just bear with me one second. Just want to go to the preview for the Bank of Canada, which is here. Apologies about that. Yeah, so today's meeting, market's really betting that the BOC will follow their Aussie counterpart by pausing their rate hikes as policymakers reach near the end of their most aggressive rate raising campaign in decades. If we cast our minds back, Bank of Canada resumed hikes in June and July with a quarter-point increases at both those meetings following a pause since January. The bank signaled in July that it continued to believe inflation would only return to 2% by mid-2025, but it left the door open to further hikes. So rates expected to be held at 5% this time. Futures markets pricing over 90% probability that the bank will stand pat, but we kind of think that a hawkish hold is likely. Officials probably yet to be fully convinced they've done enough to get inflation sustainably to 2%. That comes, of course, on the back of stronger than forecast inflation at 3.3% in July, while the housing market, struggling housing market, kind of shown some signs of a revival. All that said, the economy is likely to slow as the impact of previous rate rises continues to filter through, and the rise in joblessness also gives the Bank of Canada scope to keep policy unchanged, which kind of overpowers concerns about that result. We did have risingly contracting residential investment noted here, budgetary factors like the wildfires. Overall, though, kind of seems more prudent for the central bank to wait until October to make any tweaks. Today's decision meeting is a statement-only decision, and we do get complete forecast updates. They are published next month in October at that meeting. So probably that's why we get a pause again. Officials will then also have 2 further sets of jobs and inflation data to consider before the October meeting. Markets, just looking at that, as I said, after this meeting, prices around a 30-35% chance of another 25 basis point hike by December, I think. So interesting. We do get Friday's on Friday we get the employment report for August, and that will certainly direct policy with improving labour market conditions really required to help the loonie. Let me just pull up that chart finally. The dollar CAD, dollar or CAD has been struggling certainly. Just bear with me 1 second. You can see here, that's the weekly, but if we just look at the daily chart, this is dollar CAD, certainly dollar really strong against the Canadian dollar, that is, and kind of surprising with this rebound in crude that we've seen, but it's certainly as well the loonie has a strong correlation with general risk sentiment and the S&P 500. Always remember that. So that has been more that you can see here. August up to now 136 here, which is, and then if that acts and 135 strong 630. Okay, that is all we have time for today. Hopefully that's proved useful to you guys. Please do tune in a couple of weeks' time, and we will speak to you then. Okay, take care.